Good morning, everyone. We are Mortgage Pros 411. I'm Audrey Boissonou with my co-host Kevin Casey, and today we are joined by the very smart and full of amazing information, Tracey King. She is the COO of Partners Credit. So, Tracey, welcome.
Thank you. Great to be here again. See everybody.
Oh, we love seeing you. All right, a few little things before we get down to it. First one is, I don't know if you knew this or not, but it is time to renew your NMLS. So if you have not taken your 8 hours, and I know there are a bunch of you, I know that. You know why? Because we're LOs and everyone thinks, I'll do it later. You can go to Mortgage Educator's website and you can use the discount code countdown and get it done. So how about you put that on your to-do list for, I don't know, now would be amazing, and get
I
it
do
over
believe
with.
the word countdown has to be all one word and all caps.
All right. I don't know if that's true or not, but you could just give that a shot and see if that works. How about that?
There you go.
All right. So, and with a little bit of Thanksgiving cheer, let's start with that since we're going to dive into credit in a few minutes and it will be a little less cheery. Mortgage-backed securities are in the green today, and the 10-year is at I don't know, it's kind of trouncing around between 4.38, 4.39, somewhere in there, but like a far cry from where it was not too long ago. So we are headed in the right direction, kids. Isn't that exciting? All right. No, you guys aren't excited?
No, that's awesome. Everything's going in the right direction.
Okay, good.
Everything.
Okay. Oh my God. Okay, that just made me think of something that I will not discuss here, but I have a little question about, I'll have to address later. All right. With that being said, it is that time of year right now for the crystal ball competition. I just want to make sure that you're clear. This is Kevin Casey's favorite time of the year, favorite topic, favorite thing. Okay. So we're Kevin, give it a go.
All right, I'm going to share a screen here real quick.
Oh God. Okay.
I know. Hold your breath.
Tracey, I should have just made it so you could share the screen and nobody else.
Right.
Oh my God. Crystal ball competition while Kevin's getting it together is
all right.
You decide.
You should be able to see this chart on the screen now.
Kevin,
yes.
You the middle of a sentence, for God's sake.
What?
The crystal ball competition is when you make your best guess as to what the new conforming loan limits are, not to be confused with the fake new conforming limits that have been published by all the lenders in the last, 12 weeks. I don't even know how long. So go to our website, www.mortgagepros411.com, and put your best guess in for the new conforming loan limit. The tiebreaker on this thing is the date that it will come out. So Kevin, knock yourself out.
All right. So last year, if you recall, some lenders came out with what was considered a crazy jump up in the new conforming limits. Just like this year, they came out with what new conforming limit, I think, is 750, if my memory serves me right, is the guesstimated number. But they always guess low. At least historically they have. This year, I think they're cutting it really close, but I thought they were cutting it really close last year, and then the number came out substantially higher than even their estimate. So the Fed's going to come out with the September numbers in the probably before our next show. I'll give people that little hint. Most likely before our next show, the number will come out. Usually comes out around Thanksgiving, and Thanksgiving is this Thursday. So, hey, there you go. Last year, if you remember, the numbers were declining quite dramatically from the summer months. It was like we thought, oh my God, numbers are going down. Those lenders that guessed
by numbers, you mean purchase prices? Purchase prices,
yes. Purchase prices were coming down. That actually works in our favor this year because they continued to go down until in December last year. And they have been rebounding since December nicely. Now, whether or not they're going to continue the rebound at the September report number that's coming out is to be seen. It may not. We typically peak out with numbers in every summer anyway. If you look at historically, you can see this chart here. You see these little bumps. Almost every one of them is a summer month. It's either August or July, it's usually. So, they bottom out in January, they peak out in June, July, August. That historical, this big peak up here, that was a huge peak, June 2022. And then look where we are right now. Look at that. As of August, we're up there again. So I have a feeling that was a peak number, but I don't think we're going to be coming off that number more. So guesstimate what your numbers are, give a little padding, figure out that we're going to be a little bit higher than we were last year, but not a whole lot higher than we were, but we still have this bottom number. So we have been rising. So, get those numbers in, and then, do a little research, maybe find out when this Fed number is going to be relaxed. It's not a unpublic number.
Okay, that's enough.
I'm going to stop sharing.
He always wants to give
Too
away
much sharing, apparently.
He wants to give away too much, and I'm always like, let them figure out what they are, like, let them figure it out. No, he wants to like analyze the crap out of it and drop all these hints. But anyway, okay, Kevin. But
remember the numbers, it's a conforming limit, only the regular conforming, not the super jumbo weight. A lot of people give the super jumbo numbers like no, they're way off because they're using super jumbo. The rest of the country is on the regular conforming limits numbers, not super jumbo, super conforming. And then the other little tip that I will give, the number either ends in 00 or 50. Don't put a wild odd number in there. So it's either ends in 50 or 100. That's it. How's that?
Did you see?
And there's a reward this year. Did you know that?
Yes, I did. I think I negotiated it. What is the reward? What is the award this year if you get the number right?
Free 8-hour NMLS class. Online.
With whom?
Mortgage educators.
That's right. Okay, so your continuing ed next year will be free if you do it online with mortgage educators and you nail the number. All right, so get your numbers in. You have to do it through the website. You cannot just post it in the chat.
Just guess $1,000 reward. Oh no, $1,000, $100 million reward. She won last year, so she wants to win again.
Well, her $1 million guess on that is probably not going to beat everyone out this year, but so Peaches Jensen won last year. Dirk has a comment in there and he says, I'm thankful for you, Audrey. And then he goes, okay, I'm thankful for you too, Kevin. So all right. All right, let's move it along, shall we? We've got a lot to talk about today. Let's start with credit, shall we?
How's everyone's mood?
Tracey King. All right, we've had enough good news. Let's talk about credit. All right, let's start with
I wore black today for a reason. Yeah.
What am I wearing? I'm wearing Thanksgiving colors. Okay. Yeah. So let's start with prices are going up. Tell us about that.
So it depends where you fall in everywhere of how this is going to impact you, but prices, yes, again, are going up as they always do, but there are significant changes which we haven't seen except for last year. So the biggest thing is if you were on tier 1 last year.
Hang on. Explain the tiers again, because just to refresh everyone's memory.
The tiers were nonsensical tiers that were created. That we were forbidden to share who was on each tier. And the reason why I say it's nonsensical, because some people felt that they were based upon production levels, but there were several that were on tier 1 that had lower volumes than subsequent tiers. So when we received the huge increase last year, people that were in tier 1 had a very minimal increase, I think under 100% or something. And then there was a second tier that had a few, just like 10 lenders, 12 lenders in there that had a larger increase, but not as big. And then everyone else fell into tier 3 and they received like a 400, 500, 600, just pick a huge percentage increase that was put into play. So this year, along with that, they're ridding the tiers. So there's no more tiers. So everyone's on an even playing field. However, those that were in tier 1 are going to have a huge increase because now they're even and they have the additional increase that everyone else is feeling this year. So when you think about the increases, what's important to know is that last year it was based upon FICO. So FICO came in and gave a huge increase. Then there's also bureau data costs that go up, but the big kind of shockwave was FICO. So there's a general increase for everybody else that's on tier 3. That's not a huge deal. But tier 1 is going to feel it. Where there's a huge upset is that many lenders started utilizing prequal reports this last year, trying to find ways to soften the blow of the cost of a credit pull these days. And so they were utilizing prequal reports, which is a soft pull, so that helps you avoid the triggers. And then also it was a significantly cheaper credit report. The problem with that was that they, for forever, have been non-reissuable. So you could not submit to the AUS, you couldn't see, you know, what was happening. So functionality wasn't really working with it, because LOs were kind of like, well, I need to see where I'm going to go with this loan. I'm not, you know, screw it, I'm just pulling both. And it just wasn't saving anyone money until Fannie and Freddie opened up pilot programs.
Right.
And Fannie's pilot was smaller. They didn't have as many lenders that were a part of it. Those that were able to get in reaped the benefits. Freddie was allowing more lenders to get into that pool to do the trial. So they were able to reissue those credit reports and be able to kind of move further along in the loan process. So here's my buildup. FICO has increased the cost of the prequal reports. So if you have that trended data, which Fannie requires for the pilot, Freddie is going to require in Q1, those prequal reports are now going to be the same cost as an actual credit report. So absolutely no cost savings there. And, you know, they are kind of clouding this as more so to move away from the trigger issue than actually the cost savings. So,
okay, so let's just stop there for a second. So basically, if you're using a prequal going forward, it's going to cost the same as a regular credit report. But while you're in that prequal mode, the bureaus will not be selling your borrower's data to 8 million other people.
And
Correct?
that still stays the same?
So I think it's interesting that these little are, you know, they know that the fire is under them as far as trigger leads go. And God knows, do we not have any idea how much they make a year? Has anyone seen any sort of documentation on what that income looks like for them? They're looking to replace it. It looks like, you know what I mean? Like, okay, we won't sell your borrower's data, but we're going to charge you more here. So, okay, let's keep going, shall we? So the tiers are going away January 1st. The people who got hosed last year are actually in better shape this year. Is that correct?
yes.
Yes.
But not as host.
Not
as hosed, but they'll still have an increase unless they will be hosed if they were utilizing prequals.
So just for the record, hosed is a technical mortgage term that everyone should be familiar with. So I'm glad to have introduced it today. You're welcome. Okay, so then, let's talk about this pre-qual versus pre-approval thing. Okay, so you said there's a difference in the verbiage that they're using and how they're doing that. Yes?
Yes, I was reading a comment from someone. I'm the brown-haired lady. To explain tiers, and then I didn't do effectively. So I just want to take a moment for, yep. I don't know what her hair color is, but I'd like to address it to make sure she understands. The tiers were what they sound like, a hierarchy of lenders in terms of what they were receiving as pricing increases last year. That's all they were. There was no rhyme or reason to who fell into the tiers. But if you were a tier 1 lender, there was a group of mysterious people that determined you were in tier 1 and would only receive a certain increase in price. The reason why it was so different is because it was a difference, and I can look back, but I think it was between like 50% for tier 1 lenders, and tier 3 lenders was like 500%. So the disparity between the two was enormous.
Yep.
And no one understood why. Again, it would be, excuse me, it was a secret. We were not, as a credit reporting agency, we were not allowed to make it public as to whom was on what tier, or discuss that in a public way. So apologize that I didn't give a better explanation about that, but it is vague and it is convoluted, and it's also gone now. So moving forward, every lender is on the same playing field in terms
of January 1st, or
As
Yeah.
of January 1st, yeah. So everyone's on the same playing field as to determining what kind of increase they receive. That was
So
the
if you're
first
in a-
time that we'd ever seen that before.
Yeah.
And I imagine the blowback was pretty significant.
Well,
Sorry, Audrey.
might have been some collusion there. Not
Right.
saying anything, but
We can't
Please.
we can't
if,
comment
if,
on
it's,
that.
if,
Yeah,
it,
that's
if it smells like a duck,
Right.
exactly. So again, so each lender last year was stuck in a tier. No, and some people didn't know this, right? And
Right.
so, but it was
they
really
just had higher credit card.
it was very unfair because some people were paying much higher fees for credit reports, but now we're all going to be paying those much higher fees, which is not great. So, okay, so there is a suggested process that they're saying that we should follow going forward, right, Tracy? And maybe
Right.
you have a visual for that you could share with us.
Let me pull this up, make sure I'm not.
When I say they, it's the bureau.
Right. So this is the bureau. So this is one of the bureaus to which information was shared on what they've provided. I apologize, I've got the wrong thing up. So this is from Equifax. And it's products and solutions throughout the mortgage loan life cycle. So important to note that a couple of the bureaus, not all, are kind of nicely, and it's now being called a pre-approval.
So the pre-qual is now a pre-approval?
There's two different kinds. So can you guys hear me? Yeah,
it's kind of
Zoom
going
You're
in and
breaking
out.
up suddenly.
Yeah.
Zoom quit unexpectedly. So pre-qual without trended data. So that's the pre-qual that does not need to be reissued.
You know, why don't we try, maybe have Tracy come back in and out again? Or should we try a phone call? Because she's gone now.
Okay, hang on.
I mean, now we've lost her computer altogether.
All right. So while we're waiting for her to come back, there she is.
There she is. Welcome
Yeah.
back. No, she's gone again.
Sorry, it just started telling me everything was going wrong.
That's
Wow.
so weird. Yeah. So
into this.
Again, for the people who weren't aware of this pilot program with Fannie Mae, they had a pilot program where we could use a pre-qual credit report to run to you and actually get an approval. So there were pros and cons to this, but that was part of what we're talking about here is they were running this pilot. We could do these less expensive credit reports. The borrowers weren't getting trigger leads. And so it was working swimmingly, we thought, but apparently not. So,
and we thought as credit reporting agencies, great. The pilot program was 2023. They're probably going to open it up. And now when we're having all these difficult pricing discussions, we have alternative methods to help you. And as everyone's been talking about triggers in this year, because the overwhelming amount of people trying to reach out to borrowers has been excessive. So we were looking forward to the year ahead, thinking these programs would be opened up and
that would have made sense. I see you're applying logic to this.
Yeah, right. And stay tuned the next few weeks. I think that we will hear some of that. Yeah, so now we have to kind of rethink this of how it works with your process, because are there still benefits of a borrower not being bombarded by competitors? Can something be said about the fact that a pre-qual is still beneficial, even though there's costs associated to it? So what I will say, and a change that should be coming, is previously pre-qual reports could not have the fees passed along to the borrower. So the lender would have to eat that cost. Well, it was, $6-10. That wasn't a huge cost to absorb. But moving forward with the new changes in fees, it does seem, and we're waiting for final, but it sounds like 2 out of the 3 have basically said in 2024, you will be able to pass along the pre-qual fees to the borrower. So that does help a bit. It's just, we're going to have to look at all of your disclosures of what you're actually reporting to the borrower. And that's probably going to go up across the board if you're utilizing this, but could be worth it. So, you know, with that, as long as the loan closes, you can pass along that fee. So the question Audrey had earlier is, you know, are we going to have to just start charging borrowers when we pull credit? It looks like you can for a regular credit report. It does not look like you can for a prequal.
Well, that's crazy, but that's welcome to mortgage world.
Well,
Right.
I think as we start to see what the prices actually turn out to be on these credit reports, as those numbers come out and as people are looking at their businesses, can we absorb paying for other people's credit report who may or may not be committed to you? So if we went back to the old days where, you know, somebody wrote a check for $50 and you ran their credit, they were a little more connected to you because they had some skin in the game. Maybe we're headed back to that, but I mean, there will always be someone who's like, well, we're not going to charge. And then that makes it difficult for everyone else. So I don't know what the solution will be, but it's certainly something that I think a lot of companies are going to have to consider.
Yeah, no, I remember back in the day when I started, you'd always had to collect that $17 check from the borrower in order to start the
Those
application.
were the days. Yeah.
Yeah. And I had to go to the trust account, and it was a trust accounting nightmare. You know, and then it was like, wait a minute, why don't we just not charge up front and eat this? And then that went into the prequal with the credit reports for the soft pulls, because it was what, $6. So who cared? We'll eat that. That's fine. You know, and the problem is, you know, what percentage of prequals actually made it to the end where you could collect the money anyway? It was small. So if you weren't collecting money on full credit reports, you might as well do the prequals, save on the upfront fees, cut the cost to the lenders. And only, you know, when it finally closed, would you pass it on to the seller? Well, if it was, you know, a small amount, it wasn't a big deal. But, you know, with these new increases, what are we talking about as far as numbers, as like cost wise for run a credit report for 3 bureaus, one pull?
Well, so the good thing about prequals is that you can reissue it with less than 3 bureaus. So you could do a single bureau, you could do 2 bureaus or 3. And a lot of people are scared of a single bureau. I get it. So they do a 2 bureau. So yeah, so like you take away, a lot of people are on kind of a bundled pricing. What do I mean by bundled right now is that when you have a tri-merge, you want to know that everything's included in that, like all of your reissues, all of your secondary use fees, all of your supplements, all of that. So a lot of times your tri-merge is going to take into effect all of those fees. So there's a pretty significant difference between a 2 bureau credit report and a tri-merge. So to your point, Kevin, there can still be benefits to the prequal, or what they're calling the pre-approval credit, if you're just doing 2 bureaus. Now, when we talk about kind of what the process will be after that, I've seen the bureaus kind of suggest a few different things where you pull a prequal and then you ride the loan cycle. Like you treat it as if it's an active loan. You see kind of what bucket they fit into, what kind of loan you can provide them. And then what they're suggesting is then pull the hard pull like 10 days prior to closing. Around the same time that people typically pull a pre-close report, LQI. Everybody calls it something different. Now, there's risk, obviously, associated with that because credit is fluid. Things can change. Their scores can change depending on, you know, if it's a loan that's going to take 60, 90 days, that's a huge risk to run. Their response is get undisclosed debt monitoring. So you can monitor what's happening with the borrower throughout the loan process. I'm not against that. I actually think that's a great thing to have regardless, just to kind of keep on track so there's no surprises at the end.
Hang on, stop there. Just
that's a new one to me.
Okay, so it's an alternative. So, you know, typically if you pull credit at the beginning, go through the loan process, gather all the information you need, and then at some companies, not all, require, you know, prior to close, pulling their credit again to make sure that there have been no significant changes. That credit at the end is a soft pull. Typically, there's no scores associated with it. You're just looking at the debt to income, or just the overall debt, any new derogatories, all like that. An alternative solution to that is something we call at Partners debt activity monitoring. Other people might know it as undisclosed debt monitoring. Essentially, you can start monitoring the file and have alerts sent to you in regards to the borrower throughout the entire loan process. So if I pulled Kevin's credit today, and 3 weeks later, Kevin said, you know what, Tracey, I'm going with you. I love you as a lender. I love your brown hair. Let's go. Then we move forward.
But I didn't tell you about the new car I just bought with the
Right.
$50,000 car loan.
So we don't know what you did in the last 3 weeks. We didn't have that conversation. And rather than me wait another 6 weeks to time to close your loan and I pull that report, you can start monitoring that borrower. And because you had pulled their credit up front and you have their authorization, you can start monitoring and go back retroactively to the beginning. So it can start, if we started the loan process on October 31st, you can plug it in and it'll send you the alerts that have happened since then. And then it'll monitor it on a daily basis. So if you have a new derogatory, if you have a new inquiry, if you have, you can kind of adjust it as you want. You don't want to be alerted on every little balance change, but you can kind of set some guardrails there so that there are no surprises. So if they did apply for a car, you can say, stop the insanity, or now and you need to kind of reconfigure their loan.
Wow. I have to say that as an LO, it is really important to know this, that we used to think, okay, you run the credit and, everything is fine as long as
They go out buy a car.
Yeah, exactly. And to know that they can do this on a day-by-day basis is really important to share with your borrowers so that they understand that it really is not a joke. Like they really do need to, keep you involved in what is going on with their credit, but also keep it under control and not do anything like, go buy 49er tickets for the whole family and end up with a credit card balance that's, $3,000 higher than it was before. So Boy,
yeah, and a lot of people do this. And Dirk just said a lot of people have been doing this. I think it's been picking up the last couple of years as well, because it does save money, so there's no surprises at the end. And then also it can save money when you're looking at a pre-close report. Do you need all 3 bureaus? You can monitor 1 bureau, 2 bureaus, so you can kind of cut down on the cost. So I think a lot of people have been looking to that as an alternative the last couple of years to keep costs down in lots of different ways.
Right, but I don't think that most LOs were aware that this was going on behind the scenes. It's really good to know that.
Yeah.
And so we had some Mark said we can't do a DU approval with a soft pull, and it was a pilot program for certain lenders that were able to do that. So no, not everyone could. And then and Dirk said that this would be a great way to catch someone that's double apping you. Yes, it would. Someone else is asking, can you require the borrower to pay for the credit report directly to the credit company and avoid the trust account?
That is a great question, actually.
That is a great question. It was definitely
that's what you do with the appraisals back in the day. Used to collect the money up front, the money would go into a trust fund, and then they said, wait, you could just pay the appraiser directly. And they're like, oh, great.
Can we do that, Tracey?
We have a way. We don't at point of sale. So I'll say that. So think of it as like, as long you can enter, we have the ability to allow our customers to enter in a credit card while they're pulling credit. We do not bill directly to borrowers, as you can imagine, that would be a nightmare. And the borrower can't contact us to pay a bill in any kind of way. But yeah, we do have direct at point of sale. When you're typing in all their information there, we do have the ability for our customers to enter in a credit card.
All right, so that's a good thing, and that's something that maybe we should start utilizing a little more often. Yeah.
Well, now that it's $4,000 to run a credit report.
Exactly. All right. So are we at a place where we can say what an average credit report costs, or are we still a few weeks away from that?
I mean, we're a few weeks away. And again, it takes into consideration what you have included, and there's so many different pricing structures out there. I hate saying it out loud.
Yep.
I'll just say that tier 1, going back to the tier, people will probably have like a 500% increase.
Holy moly.
Tier
So
three, probably.
what's the difference in pricing between a tier 1 and a tier 2, like just dollar wise?
I mean, think about what your credit reports cost 2 years ago. That's what tier 1 pricing basically was. I mean, let's like throw out just, I'm playing numbers here. It'd be a tri-merge for $45 tier 1 versus $90 for tier 3. I mean, yeah,
That's crazy.
And if they all go up, there might be $100 next year or something.
I mean, there are people that already have that right now. Yeah.
Okay.
Okay. Holy moly. Okay, so can you give us an update on the tri-merge bi-merge rollout that was supposed to be happening as we speak, but got postponed? Where are we on all that?
We are exactly where we were months ago, which is nowhere.
Perfect.
There's a lot of talk about it.
Mhm.
They've extended these kind of forums that they're having for people to give input. All of the forums that I have been involved in are the same forums that I had gone to the previous time. It's a lot of kind of, what do you guys think about this? What would it look like? How would it do? I was telling Audrey, I was at MBA in Philadelphia, and I went to a panel in which they had someone from FICO, FHFA, and talking about it. And they were saying, hey, get excited. This is going to drive down costs to have competition between FICO and Vantage. Now, what you guys haven't seen yet is Vantage. We've always been able to get Vantage scores, but nobody wanted them because the GSEs didn't accept them.
Right.
Vantage score just increased their pricing 400% this year. And at, based upon their timeline of how everything's going to work, and I can share my screen again to kind of show, or I can share a link that the GSEs kind of have a roadmap for.
Why don't you do both? Do both.
Okay.
Why don't you show the screen and do both? And someone made the point that this could be an issue if we're collecting money up front before getting the intent to proceed signed. So like,
oh, for sure. I mean,
so make sure
the
you
only
guys are really looking at
explanation.
that. Yeah, it's a great point.
Although credit and appraisals are the two fees that you can collect, whether or not they close a loan. But yeah, the intent to proceed might be the issue.
Yeah. All right. Let me pull this up for you guys real quick. So, when I was at this panel, once again, they're talking about how advantageous this is going to be. And then I got up at the end and was annoying and said, you said that this is going to create competition and drive down costs. However, we've never seen cost increases like we have. What is the plan when you're going to have FICO 10?
Tracy?
This happens every time I share my screen.
Oh, that's what it is.
Unshare that.
Okay, so you'll just send that to me. We'll embed it in the YouTube channel. We'll do it that way. But maybe just tell us about it then.
Okay. Sure. So, well, I'm scared.
Don't be afraid. It'll be fine. Last week I disappeared entirely.
Unshared, and then we lost her again.
Yeah, exactly. All right, she'll come back. So, with that,
what's interesting, Audrey, is remember last year, so they came out, we were in DC, and they came out and they told us about all this stuff that's going to be coming down. Trace, we were talking about April last year when we were in DC, and Vantage came out and did this big presentation to us about how these are all the changes that's all going to happen. And then so we got the spokesman person from Vantage to come on our show, and this was like early April in DC.
It was weeks. It was literally weeks.
I know, and it was May. Like I can't remember, mid or maybe it's like 6 weeks later at the most.
She knows. She came on.
Everything had changed in 6 weeks from what they were proposing in April, what they're doing. And it sounds like it's kind of the same thing now. It's just a moving target. They don't even know what they're doing.
So what this link will take you to is Fannie Mae kind of has this roadmap and proposed implementation timeline. And what they're wanting to do is the first thing would be to go to a bi-merge. They still have it listed as the first quarter. I would be shocked with that because, you know, the word of the year is guardrails.
It's
How
6
do you
weeks away.
know? Yeah. And how do you know who's going to pull a tri-merge and then they're like, well, I like these two scores, so now I'm going to pull it again. You know, who's in charge of regulating that and how do you do that? So that's some of the questions that have come up. So they still have it as Q1. I doubt that would happen. Later in the year is when they would have all the different score models on there. So back to Philadelphia, that was my question as to, at one point, you guys have on your roadmap having 3 different score models on for a borrower. So, you know, rather than having a tri-merge, you would have with 3 scores for a borrower, you have 9. If you have, you know, a joint, that's 18. So who's actually paying for that data? And the response received was that's a great question. Thank you for your input. Nothing was answered and all of this. So it's a bit daunting and scary. And they also did a survey of the crowd of who thinks we'll be ready for this in a year. No hands. 2 years, no hands. 3 years, people started. But just the technology behind it, every LOS system, every POS system, credit reporting agency, you know, LOS, how they bring in that data, send it out, all of that has to be taken into consideration, let alone the compliance factor of it all. I think it was, let's get this out there and get people excited so we can increase the costs. And
yeah. Well, okay. So I just want to take a moment and just to be clear, a buy merge is doing 2 bureaus or 2 sources. A tri-merge is 3. That's what we do right now. A buy merge. So we would go to 2, but if you recall, I don't know if you are, and if this is confusing, it's confusing. That's like when we came back from DC, we had Vantage come on, and then I had Tracy come on right after that because it was so confusing that we had to clear up some of the fog. And it was still confusing. So again, we're just sharing what's going on out there. And it's important for your borrowers to, I mean, they're going to hear about this eventually, but also if they end up doing some of the changes that they had spoken of in DC, one of them was that they would have all of the utilities and, you know, the extra credit put on the credit report, not as an option, but perhaps as everyone, you know, everyone's utilities were reported to the bureaus, et cetera. Have they commented on that recently? Have you heard anything or?
No.
All right.
And it's very confusing. It's super confusing, but if I can just, you know, a lot of it is smoke and mirrors and our voices are, it's like, we're kind of being heard, but not really, where credit's too expensive. Don't worry. We're bringing it down to a buy merge. We're not effectively reaching out to as many borrowers as we can. There are unscorable borrowers. Well, good thing we have new scores coming, methods should open it up. So they're really focusing on, look, we're going to have $1 trillion more in loans for these borrowers. No, you're not. That's like best case scenario. All of these things fall into place. But it's kind of focusing on that rather than, and what I think LOs need to focus on and who they're having discussions with is, you know, what does this look like for you and the price of to close a loan? And are the borrowers impacted by this? You know, in terms of timelines, all these things are going to happen, but I think that it's important to talk to your company to see if you guys are attending some of these forums, even though they are redundant. It is extremely important to have voices heard and to work with like your state MBA or your brokers association or whomever you're working with, that collectively we come back and say, we need to talk about this, because the CFPB so far has said that this is outside of their realm, that they don't get involved with the bureaus or pricing because it doesn't directly affect the borrower.
Is insane.
Yeah.
The biggest, everybody's biggest bill is credit these days, for the most part. So
crazy. Okay, so we had a request here. Can Tracy provide any insight on the differences in the 3 bureaus that would help someone who wanted to use less than 3 bureaus decide which bureaus to pull.
Yeah.
You can say no.
Here's what I will say. I will say that I can't say to you that, you know, and I've been doing this for 20 years. Back in the day, if I went back in early 2000s, I'd be like, Equifax is the one that has the student loans. Or if you wanted a smaller business, that would be TransUnion. It's all, you know, that's long gone. They've really kind of evened the playing field. A lot of times scores differentiate based on your region, demographics, all of this. And where I can't say Experian's always going to be your mid score, what your credit reporting agency, so that's my company, whatever, whomever's pulling your credit, you should be able to go to them and say, what is my average mid score and what bureau does that come from? So we like to provide data to our customers that say all of this and kind of can show them a roadmap of, hey, January of last year, your average mid score was 620. Now it's 630 or whatever it may be. And then also tell them where each bureau falls in terms of what their average was on a monthly basis. So
and I bet those scores vary by location, state to
right.
state.
It's a lot of times regionally it can make an impact, but so that's why I'm saying I don't have an answer for the bureau specifically, but as a business, you should be asking these questions to the people that are providing you with that data. They should be able to collect that for you and provide it to you so that you can make those kinds of decisions.
Well, when I heard, I don't know who was saying this, whether it was Fannie, Freddie, or whether it was, I think it was one of them. And they were saying that we weren't going to be able to cherry pick the bureaus when this finally did roll out. So I don't know how on earth you would regulate that. I mean, if somebody knows what their credit, let's say they applied somewhere else, right? They applied with lender A and they figured out what their credit scores were. How would you stop everyone from not taking that information?
Yeah, just ask the client, say, go look at your credit card report and it tells you where your scores are. Okay, tell me which of those two companies are the highest. We'll run those two.
I think those are all Vantage. Well, here's another question, Tracy. Are other industries impacted? Credit cards, card loans, personal loans, insurance. Have their credit reports gone through the roof like ours have? Because it just makes you wonder if somebody's standing in line at Target and they're offered a credit card, is Target paying way more for that credit report than they did 2 years ago? Or is it just mortgage credit?
I can't 100% speak towards that, but I will say I am doubtful that they have because we have a specific score model. So similar to what, you know, FICO is moving to FICO 10T, and we're going to Vantage. We have a mortgage specific score. So that's why when someone goes and pulls their credit and they're like, well, I just went here, my score was a 720 and you pull it and it's a 680. It's a different scoring model. So when we pull credit and when we sign up with the bureaus, there's a specific permissible purpose that we have to have our customers fall under. So, you know, as we're talking about, well, the GSEs are now going to be accepting these. The FICO and Vantage are prepping for this. That's because it is specific to the mortgage industry. So I am doubtful that these other places are going through something similar, but I can't, you know, I haven't been deep into, I'm already overwhelmed with mortgage credit. I don't want to know about auto Target cards.
Something else, how they're pushing the Vantage scores and such, and they're saying, hey, it'll help minority home buyers.
Right.
Like, oh, because it'll open up and they'll have more credit reporting and such, you know, i.e. that they'll report their utilities and that such. And I recently had a client who was a minority and they had listened to somebody who said, oh yeah, you should voluntarily start reporting your utilities bill on your credit report. And the reason they came to me was they had been declined by a couple banks. And when I got the loan application, I ran credit, I saw why they were declined. It's because they were running the ratios and they were using their utility bills into their ratios because it was data was flowing right from the credit report into the 1003. And therefore, oh, wait, you have an extra $400 a month you're spending on your gas and electric bill each month. oh, that goes right into your ratio, and bang. And now, so I was at least smart enough that I saw that and backed it out and stopped reporting it. And then my ratios were just fine. I mean, they were solid in the 30s. And it was like, how is that helping minorities? I don't quite get how that would help minorities in that particular case. Or
well, I think it's, we have right now, when you have a borrower with a thin file,
Thin file means not much credit, right?
not much credit. There's nothing there. So people need to bolt it up. We have people saying, can you add alternative trade lines? So they'll ask us to do a supplement, put their Netflix on there, put their gym membership. We've had someone being like, can you do their laundry bill? I mean, people are trying to add things on. But the misconception right now, Equifax has something, and Experian had Experian Boost for a while to add this kind of data to the credit report. But what's important to know is that where the data will be there, they're not being scored. So it's not.
So my Netflix bill pay does not affect my scoring.
Correct. Or the utilities that people have asked to appear on their credit report, it's not impacting their score. It's just additional data. So now I do not know the specifics of whether or not that will be scoreable in the upcoming files with the score models. My understanding, it's the same data, but they're looking at it differently. So Vantage is saying, for example, I believe on a FICO right now, it takes 6 months for a new trade line to start impacting the score.
Really?
Someone else is saying that it will take a month or only 2 months, or we can start looking at newer credit and have that applied to have different weights applied to the data on the file that can help generate a score if previously they didn't have a score. So that potentially opens up thinner files that can be more scoreable, but we don't have the details on it. And honestly, we talk about down the line, we're really not going to know the differences until they are all on the same credit report, because I think that also is when collectively they're going to be reviewing and understanding the data. I think that's why there is that time frame where they need all three to be on the same credit report, because they need to know how to weigh each other. If you decide you want to use a Vantage score over a FICO 10T, what's the difference? How does that help? How are the GSEs weighing the risk? So I think that there's a lot of, and what I was talking about before, smoke and screens of like, this is going to increase and you're going to have so many different borrowers and reaching this population. We don't know, right? Until this actually gets put into play. And I hate it because it makes people think a certain way, or they hear certain things that are half truths and just they aren't fully educated on it, where you can't get everyone's rental on a credit report because most people have private landlords, or they're not a part of a conglomerate that reports that information in. So it's much trickier. And I think that it's better to talk to borrowers about how to build credit and how to do so responsibly.
Okay.
But
so
that takes time.
I want to run through a number of things really quickly. So first of all, more people are asking for increases in their credit limits right now. And the rejections on credit inquiries are higher than they have been, especially on things like cars. Retail sales are showing that people are spending mostly on necessities, not so much on the luxury or, just I want that goods. And the inquiry into, do you have $2,000? Could you come up with $2,000? They actually surveyed people and asked the question. It's the lowest number right now since 2013. So credit is tightening up. Things are getting harder for the consumer. And this is an opportunity for all of us, especially as the rates are edging down ever so slightly. So it is a time to stay in touch with your borrowers, get in touch with them. How are they doing? And there's so much of a mindset that, I've got this really low mortgage rate, I just need to keep it. And that may not be the case. Make sure that you're reaching out to people and talking to them. So, and I just wanted, VA just ruled, they just said they've requested a temporary halt on foreclosures for veterans on guaranteed loans until May 31st, 2024. They're trying to bridge the gap and make sure that veterans are protected as there is as we're kind of coming off of the COVID era forbearance and stopgaps that were put in place. So on that, it was interesting because mortgage forbearances are lower. They've gone from 0.31% to 0.29% of servicers volume. We still have 145,000 people in forbearance. That's not a lot. October of 23, Fannie and Freddie were at 0.18 of their loans, and Ginnie was at 0.52. So again, really low numbers on the number of people who are in trouble, but Fannie and Freddie are ending COVID as a reason to get a forbearance this month, and FHA, their period ends at the end of November. So some of the things that were in place before are not there now. VA is trying to get ahead of that, make sure people have options so they don't lose their houses right out of the gate. The other thing I thought was interesting is that 45% of borrowers who are in foreclosure are not foreclosure, in forbearance, I apologize, are due to a temporary hardship like divorce or illness or loss of job. 43.3% are still in forbearance because of COVID, which I find interesting because I didn't even realize that was still a thing. And then 11.3% of people are in them because of natural disasters. So I just thought all that, just to get a grip on that's still out there, but it's shifting big time. Be in touch with your borrowers, be in touch with your borrowers, be in touch with your borrowers. Also, I heard an interesting thing on MBS Highway. 67% of buyers use the first realtor they talk to. 67%, that's a big number. And so, I mean, as much shifting as we think we see, it's not as much as I think it actually is. Existing home sales, they are down, obviously, because of inventory. This is really normal this time of year, though, to see an inventory build. I just want to keep reminding people that the headlines are telling you it's a big, horrible thing. It's not. It's really normal and natural.
Yep.
Also, to go back to, remember when oil prices started going up like August? And remember when,
and how low could them?
And yeah, so remember I had said one day that has happened the last 2 years, and they usually start edging down in November, December. And I went away for 2.5 weeks. I came back, gas prices were at least $1 less a gallon than they were when I left. So
you go away again then? Go away.
Yeah, right. Yeah, don't tempt me.
Did you guys did you see the Wall Street Journal? And I was trying to remember it as you were talking about it. They just did an article a few days ago, and the headline was, "Congrats, your house made you rich. Now sell it." And it's reaching out.
Yeah, I saw that one. Yes.
Yeah, about boomers. And it's like, there's going to be a time coming soon when all the boomers are going to try to sell their house. Don't be the last one to do it. And I have seen more articles similar to this that are kind of trying to entice people to sell, or saying why it is a good time for you to do that. And I always find it interesting, wondering if it's like a little push to the market to try to open it up a little.
Interesting if the Wall Street Journal's weighing in on that whole narrative.
Right.
Okay, so just also in other news, first-time home buyers, we keep saying that it's so unaffordable. They are 28% of the market currently, and that number fluctuates very little. It was 27% of the market last month. Cash buyers are at 29% of the market. Investors have gone from 18% down to 15% of the market, and bid over asking is 2.5 from 2.6. So it's interesting. The other thing too is we've really tried to stay away from the recession word, just because it was just so tedious, and we'd been talking about for 6 million years. It is interesting because there are more signs that we are headed that direction. The Conference Board's leading economic indicators in October, it showed that we were down 3/10 month over month. It was worse than expectations. That's 19 months in a row that confidence is down. And the last time we saw this was before the meltdown. So 22 months typically from the start of that index being negative to being in a recession. And so the idea is probably Q1. And for us, rates often will be better in a recession. So, again, nobody expected rates to hit almost 8%. And so we thought we were going to be coming down from like 5% to something better. Now we're coming down from 8%. So we don't really know what they're going to end up being.
5% will be awesome.
5% sounds amazing. So I think that worked, right? So anyway, there is a lot going on out there, kids. Rentals are getting better, like the price of rentals. And so there's a lot happening out there as we head into December and the last part of this year, which everyone needs to be really focused on. What are your systems? How are you positioned to make 2024 better than 2023? What are you going to do? You don't need to wait till January 1st. You need to get all of that together. Like, do it now. Do it now. So you get the turkey out of the oven and you sitting around for a while waiting for it to, chill.
And ask us, so where are we having Thanksgiving next year? Who wants to buy a house? They have their own dining room table. I'll help you do that. That's what you want to do for Thanksgiving.
That's right.
That'll get you one loan this week, and you're good for at least,
Yeah. I mean, we need to be positive about mortgages going into 2024, really. So yeah, the credit report's going to cost what, $8,000 a piece at this point, but
Like it keeps going up.
do you like how I like how Tracy has not actually given us a number, and in her defense, you can't right now because it's still in flux.
you know it.
So in a couple of weeks, when it is more definitive, we'll make sure that we're sharing some of that with you. And she keeps me up to date on what's going on, and like if something needs to be shared, we will share it for sure. So so to Bill's question, so for brokers pulling credit next year, how much will it cost? We don't know yet, but we should have a better idea in the next
Come
couple
back next year. We'll know.
Yeah, I would say, look at what you're paying right now, and depending on, I mean, you guys, I don't know who you're using or whatnot, but I would say probably look for at least a 30% increase on that cost if you were tier 3.
Ugh.
At least.
Ugh.
Well, tier 3. Okay, if you're 30% at tier 3 and instead you were tier 1, you're at like a zillion percent. So
it's like 500. If you're tier 1, it's like
500%. Wow.
I just can't, I don't understand how the regulators can just look at this and go, well, doesn't really impact the borrower. How do they do that? Oh, I'm making a phone call, Tracy. I am
do it.
Yeah. Oh, I am making a phone.
He knows who to call too.
You should have asked Mark. You had him on the other day from the CFPB. I reached out to him before directly, and he was wonderful and responsive.
He is wonderful.
I need to do that again. I really like him a lot, but I think we all should start pushing a little bit more on this.
Yeah. Well, if you see anything that we can push out and have people be a part of, if there are calls to action, if there's some, place that we should be writing or commenting to, please let me know and we'll share that, because we all need to be part of this conversation. The time is over where you just sit in your office and you put your head down and you think, I just do loans, and you don't worry about all this. We need to come together as an industry more now than ever.
Go to your association events. There's a whole bunch of holiday parties coming up.
Okay, thank you, Kevin. Okay, so yes, there are, we are aware of a number of them. So on December 7th, there is a party in Silicon Valley. There's their usual midday holiday lunch. It's wonderful. And then is it that afternoon, Kevin, that San Francisco has theirs? And then Greater Ventura has theirs on, oh good God, when is it? Hang on, it's somewhere here. Anyway, there's a lot going on out there. Hang on, I am looking for it because I know that Peaches texted it or sent us a message. Okay. Oh, that's also on December 7th. So that's in Southern California versus Northern California. So again, guys, go out and support the associations who are out there, slugging it out for you, at least most of them. And there you go.
And so, just because I should say this too is because I don't want credit just to be the only one being slammed. Take a look at your VOEs and get ready for a nice increase there too, and start making some noise about I don't know who's listening, but the work number. So
wow.
Yeah. Well, again, I find this interesting because it's the employers who are choosing to use the work number, right? So you're choosing to throw your employees into a position where they have to pay that fee. So maybe people start pushing back with their employers too, saying, hey, it's too expensive, or, you know what I mean?
Yeah.
Remember the
Or
good old days where
we
we
as an
just-
industry start saying, all right, well, maybe it is time to get borrowers involved and start doing that kind of digital look at their checking accounts or their payroll and start, logging into those systems for alternative methods. Because yeah, the work number seems to have had a monopoly for quite some time. There's some competition coming in, and what do? They raise their prices $10. So
That's crazy. We have another comment. I'm hearing that inactive brokers are being dropped by their credit providers. Do you know anything about that?
not on my watch.
All right. Well, with that being said, Tracey is the COO of Partners Credit. If you have any questions for Tracey or would like to inquire about their services, for God's sake, let me know and I'll put you in touch with her. Otherwise, we'll just write your number on the bathroom wall, Tracey, and they can find you that way. And with that, I just want to say thank you very much, very, very, very much for being here today. We love you and are so appreciative of the
Wonderful
information.
Thanksgiving.
To
Thank
everyone,
you.
have a great Thanksgiving. Really, we have so much to be thankful for. Yes, we know it's been a rough year, but we're still here, and we have new opportunities that are coming up. That's nothing but opportunities coming up. So we're going to talk more about that in the next few weeks. With that, have a wonderful holiday with your friends and families, and we will see you next Tuesday at 11 a.m. Pacific time and 2 p.m. Eastern time, or wherever else you fall in the middle of that, Tracey.
With
All right.
new conforming limit numbers.
Oh, good God. Yes, of course.
More graphs and charts. Well, I'm
All
thankful for you all and for the opportunity and also my friendship that's developed with you guys. So thank you so much. And I hope everyone I'll do my, are you ready for it? That's my turkey.
Oh, wow.
You can thank me later for that. Just always stay humble, everyone. Always
talk about a plus for the people who held on to the very end.
Keep yourself humble. Always have fun.
Oh my God, that's great. Thanks, guys. Have a wonderful holiday. Bye-bye.